Ladies and gentlemen, please welcome your panel on Global Energy Outlook, moderated by CNBC reporter and anchor Hadley Gamble.
Good morning, everybody. Thank you for waking up for all of us. Welcome, of course, once again to the Milken Institute Summit here. We're going to be talking today about the global energy outlook. And just as by way of introduction, if you're not as familiar with my work, I am the anchor for the Middle East for CNBC News. I'm their international correspondent based in the region, which means that I have eyes on not just the oil markets, but all of the transformational changes that are happening in these petrodollar-based economies. And let me tell you, there are a lot of changes, and it's going to be something that will be felt globally. I want to kick off by introducing my panelists. We have Greg Beard. He's the Global Head of Natural Resources and Senior Partner at Apollo Global Management, Spencer Dale, the Chief Group Economist at BP, formerly with the Bank of England, and some man that needs no introduction, Dan Yergin, the Vice Chairman of IHS Markit. I want to kick off with Dan, because I would love to set the scene of where markets are today, because there's no way we can figure out where we're headed unless we understand where we are today.
Well, I think that markets are tight. The Iranian sanctions are going into place. The administration has said zero exports from Iran. It's not quite zero because there's some barter oil that will be done at the same time. And I think there are two big things that are having an impact on the global market, both coming from the United States. One is shale, and the other is President Trump.
And when you think about what's going to happen next in terms of that relationship, we hear so much rhetoric coming from the White House. There are a lot of fears about NOPEC legislation, something that a few years ago would have been unheard of. Where do you see OPEC's role in this, and particularly OPEC+?
Well, we were talking about that just before this was beginning, and I think the OPEC's role has changed. I mean, it was an organization, and its history is a confrontational organization about price. I think it's now more about stability in the market, balance in the market, and it's had to learn to live with U.S. shale, and that's an ongoing process.
Absolutely. How do you play this as an investor, Greg?
The volatility in space right now has been great and is likely to continue to be volatile. The public markets are essentially closed. The debt markets are a fraction of the size of what they were years ago. Private equity is filling a lot of that space. We've increased as a group to more than $100 billion of investment activity in 2018. Meanwhile, the public markets only had $2 billion of equity issuance in 2018. So I think we're really filling that gap. At the same time, Apollo, we can invest across the capital structure. Occasional distress in the space we take advantage of. So I think we're one of the few that can do what we call really asset level underwriting in addition to restructuring analysis. I think the space is really filled with participants that just do the geologic work and not so much the distressed. But given the volatility and the still situation of over leverage in the space, we expect that opportunity to continue.
As an investor, how do you read the situation today? Because obviously we were just sitting in the back room looking at the cover of the FT, and it said Iran's economy has collapsed off the back of these sanctions, which is a bit far, I would say. But how do you read the situation today? Because markets are sensitive.
Yeah, so I think as an investor, you have to start with humility and recognize that predicting the price of oil is extremely difficult to do. So I think we do study it, though, just to make sure that if we're on a verge of a massively oversupplied situation or undersupplied, I think you could figure that out at least a few months out. I think, as Dan said, the market is pretty well balanced today. With WTI in the low 60s, it feels like the industry can make enough money that in most basins returns are positive, and in fact, I think the industry free cash flow growth which was really non-existent 2 years ago. I think the majority of the companies that are public today are growing free cash flow.
Spencer, what's your take on this as an economist? Because obviously you have eyes on not just what's happening, of course, in the United States with the shale production, but globally as well, and particularly what's happening in the region.
So I think in terms of the near term, as Dan said, the market's tight, and it's all been driven by supply issues. It's not a demand side story, it's all supply issues. When you think about the decision not to renew the Iranian waivers, exactly how much the Iranian exports will come off is unclear. They're exporting around 1 million barrels a day today. It's unlikely to go to zero, but it could easily take 500,000 barrels or so off the market very easily. that supply that was taken off is likely to be met, particularly by other OPEC members. But in essence, what this is doing is taking 500,000 barrels of spare capacity, which currently sits within Saudi Arabia, and taking that off the market and putting it into Iran. And so I think the way the market will be focused in the near term will be thinking just how low will those levels of spare capacity go. If that's all that happens, I think the market will not sort of start to tighten too much. But if at the same time Venezuela comes off more dramatically, there's a lot of movement in Venezuela today as well, if you look at the news. Libya is concerned. And so I think a focus in the near term will just be levels of spare capacity and how tight could those go. And I think beyond that, it's US tight oil looks like it will be the marginal barrel supplying the market for the next few years. How quickly will US tight oil grow through the second half of this year as some of those pipeline constraints, which are currently acting to constrain production, as they ease, how quickly does tight oil start to grow? And my hunch is that sort of sets the price as the marginal barrel over the next few years.
And one of the things that I've had the privilege to do over the last 10 years is really get to know many of the energy ministers, particularly in the Middle East, Saudi Arabia, the UAE as well. One of the conversations that we have continually is the geopolitical question and how much that's influencing the market. Dan, when you take a step back and look at what we've seen over the last few decades. In 2011, there was a real conversation and a real lobby in Washington arguing against the trillions of dollars that we spend to essentially put the Fifth Fleet in Bahrain and defend the Strait of Hormuz. And then in the last several weeks, yet again, as a result of these Iranian sanctions, as a result of this geopolitical tension between Tehran and Washington, that 21-mile stretch of waterway has become once again a very, very contentious one and a very, very important one when people are talking about what's going to happen next in terms of the volatility of the oil markets. How do you see this playing out in that kind of historical context?
Well, geopolitics is really important in the oil market. One change is that, as Spencer was describing, the growth of U.S. shale is a question, and I think this is what's kind of in your what you're getting at is how does it change the geopolitics of it? And it doesn't mean, clearly the United States has not walked away from the region, which I think some of the people you know were quite concerned about that. They said, don't leave us, we're there. But what is striking is that the U.S., in its foreign policy, has a degree of flexibility that it simply would not have had 5 or 6 years ago. And I think that's a big change, and I think it's still being assimilated what it means. I think another area is we're going to see the growth of U.S. exports. If there's a trade deal with China, U.S. exports of oil and gas will be an important part of it.
Absolutely. I think it's an interesting fact to note that over 100 years ago, the lights in Mecca and Medina were kept on by U.S. supplies of crude oil. And I think it's really interesting to note that where we are today with the rise of shale production, that game changer when it comes to the U.S. relationship with the Middle East in particular, because frankly, it's upended everything.
Can I just say, the tight oil affects the U.S. and it affects that relationship. It also just affects, I think, global oil markets more generally. In a sense, we've moved, the whole dynamics of global oil markets over the next 20, 30 years, I think are likely to be very different to the last 20, 30 years. We've moved from a world of scarcity to a world of abundance. You think about oil markets over the last 20 years, they're a really odd market, okay? Somebody can produce a barrel of oil, Saudi Arabia can produce a barrel of oil for $2.84. Somebody can then produce the same barrel of oil for 10 or 15 times that amount in terms of, say, Canadian oil sands, and they all stay in the market together. What other market in the world do we know where somebody can produce the same good for 10 or 15 times the cost of somebody else and they stay in the market? Okay? It's just a very odd market. Why? Because up till now, those low-cost producers have said, I'm not going to just increase my supply today and compete you out the market, which is how normal markets work. They said, no, I'll ration my supplies, so I can keep on producing oil for 60, 70, 80 years. In a world of scarcity, when you thought you was going to run out of oil, that made perfect sense. The world's never going to move out of oil. There's a world of abundance. If you're sitting on 60, 70, 80 years worth of oil, do you think a barrel of oil in 80 years' time will be as valuable as a barrel of oil today? I don't think so. And so as you shift from rationing to abundance, that just changes completely the nature of dynamics of that market.
And I think, Hadley, in the part of the world where you live and that you're such an expert upon, clearly you've seen their mentality responding to what Spencer said, is thinking,
Absolutely.
It used to be said, we got to save the oil for our grandchildren. Well, the grandchild's now in charge, and they're thinking about the world differently, that oil doesn't have its monopoly on transportation, and there's a lot of oil.
Very different.
Oil in the ground or money in the bank? What would you prefer?
Yeah, that's right.
Exactly, and I think it's been very interesting over the last year as well. We all saw the report that came out, the Saudi-backed government report coming out of the Petroleum Institute in Riyadh, essentially saying what happens after 2040, what happens when we're really, really in trouble as a petrodollar-based economy. Because even with this Vision 2030, can they move fast enough beyond this to keep the lights on, in a sense? But what does that mean in terms of the demographics there? Because obviously Saudi Arabia is evolving, Saudi Arabia is changing. The Middle East, OPEC, is a different organization than what we've seen over the last 50 years or so. What does that mean in terms of who's going to take that predominance? Is it going to be the shale producers, or is it going to be some sort of clean energy mix?
So, we've done some work to try to figure the answer to that question out. But before I get to that, I'll just say, if you looked at the past few years, I know you can talk about Venezuela or Iranian sanctions, but the story has really been U.S. shale. The U.S. shale has taken essentially all of the global demand growth, and we study not only the oil markets ourselves, we study those that study the oil markets and say who's getting it right. The pace at which the shale sector has been able to grow is millions and millions of barrels faster than what even the best oil prognosticators could have ever guessed. So we're sort of debating, hey, we're losing 100,000 barrels from Venezuela. The market is going to get tighter, but the overall context is shale has added millions and millions of barrels in the past even 3 years ahead of what was expected 4 years ago. So this is not like we got this really wrong over a 20-year period. We're wrong last year. Even like if we study like September of 17, most were saying that U.S. shale would be what, Dan Spencer, 11 million a day, 10 million a day, 10.5 million a day, and we ended up finishing at 12.
Yeah.
So in just a tiny period of time, we're really wrong. And so we're sort of debating about, okay, what's going to happen with precision to these countries? Meanwhile, this wave of oil is coming out of the U.S., and it's only stopped now by pipeline constraints.
Yeah, and if I can say, in the history of the oil industry, the only semi-comparable comparison is in the late 60s and early 70s when Saudi production really surged, but it was not on the scale of this. That basically what Greg has just described has actually never happened before on this scale in this entire industry's history.
Unprecedented change. Walk me through who you think those the major players, though, are going to be. I mean, we've said that we've been wrong before. We expect we can probably be wrong again.
I think what's wrong now is that the perception that we'll all be driving electric vehicles or riding our electric scooters to work, and if you looked at the adoption rate assumptions, even from 2016 to now, those are down 30%. So we're not adopting electric cars as quickly as what we would have thought. And in fact, it's the installed base of 1.2 billion cars. That just dwarfs the 5 million electric cars that are already out there. So you could take a hyperbolic growth rate, and you'll still end up, all you're really doing is offsetting a little bit of maybe half of the demand growth. So maybe oil demand won't grow as quickly as it would have otherwise, but we have another 20 years of growth before we peak and shrink again. I think the perception is that, if you read a newspaper, you would say, hey, oil demand has peaked. What do you need this stuff for? It's dirty, and, it's carbon emitting. It's over, but not so fast.
Not the reality.
It's not the reality. If you just looked at the data, we would say over the next 10 years, maybe electric vehicles might displace 2 or 2.5 million barrels of oil demand. And, of course, oil demand grows at between 1 and 1.5 million barrels a day. Per year.
I think you had numbers on this, Dan.
Yeah, well, I have some numbers. I know that Spencer will have some numbers too. So there are two sets of numbers to share that come out of our mobility service. One is that our estimate is there are about 1.4 billion cars in the world today. By 2050, there'll be about 2 billion. And of that fleet, about 1/4 will be electric vehicles. That means that's equal to about the total growth from where we are today. But the other thing, to get very local and granular, half of all the electric cars sold in the United States are in California. There are 189 zip codes. Out of 43,000 zip codes in the United States, 0.2% of the zip codes have 25% of the EVs, 0.2%. You'll all be shocked to know that all 189 of those zip codes are in California, LA County, Orange County, and I think it's Santa Clara County. And I know there's at least one friend here drove here in his Tesla, and probably a few others did too.
When you sit back and look at this from a more global perspective, Spencer, obviously the questions that we were discussing yesterday during a similar panel to this one, I know that Bob was participating in that conversation, and it was very interesting to me as an international correspondent for CNBC to look at the American perspective a bit more broadly and try to get in the sort of mind meld of the United States, because usually when we're sitting somewhere else in the world, we're talking about the climate accords, we're talking about Paris, we're talking about very, very rapidly changing, certainly for global energy companies, CEOs' plans, strategies about how to deal with climate change, whereas in the United States, we're still talking about it as if they just discovered it yesterday, and maybe it's going to be a problem.
No, the energy transition is happening, and certainly as I travel the world, the way in which people talk about the energy transition and transition to a lower carbon energy system differs. For a company like BP, we really want a rapid transition to a low-carbon energy system. We really want to achieve those Paris climate goals. Now, at this point, some of you may think, well, that's a really odd thing to say. Come on, guys. You sell oil and gas. Surely you don't want that. If you think about this for more than 30 seconds, okay? So your initial instinct is, well, you sell oil and gas, so surely you want that. Now think about it for more than 30 seconds. If you accept that climate science is real, which I think the vast, vast majority do, certainly I do, then at that point, moving to a low-carbon energy system is inevitable. You have to get there. So the only thing which is now up for grabs is the speed and nature of that transition to a low-carbon energy system. So a rapid transition, a rapid orderly transition, would be clearly very challenging for companies like BP as we shift from an oil and gas company to an energy company. That's a hard thing. Now think about any other strategy where you don't have that rapid transition, an orderly transition. You're on an unsustainable path. You know, the longer you're on that unsustainable path, the more disorderly and the more dramatic your adjustment path will have to be at some later date. Suppose we're on the same path we are now in 10 or 15 years' time. How is an oil and gas company can we invest into the future? Because we know at some point we're going to need to take this huge deviation away. So for us, we care deeply about achieving Paris, not just because we have children and grandchildren, not because we employ thousands of scientists who understand climate science as well as everybody else in the world, but from a pure hard-nosed business perspective, because if we don't do that, running a business will be very hard to do. And so we will keep on making this message that I think BP are and needs to be part of the solution to this for our own self-interest.
Greg, I think you wanted to add something there.
I disagree. I think
which bit? On the climate science or the logic of once you accept it?
I think on a few fronts. One is we're seeing now the majors are wanting to own the Permian Basin again. So I think if the major oil companies were really excited about a transition, they would be buying Solar City, not buying Anadarko. So I don't.
So you look at. But this is arithmetic, okay? So in a world in which you have a rapid transition to a low carbon energy system, the world will still be consuming huge quantities of oil in 2040, 2050. So in our analysis, we say about 80 million barrels a day in 2040 in a scenario consistent with meeting Paris. The IEA say 70 million barrels a day. If the world stopped investing in oil today and just let natural declines, it would only be able to produce 20 or 30 million barrels a day of oil. Okay? So under all scenarios, you have to keep on investing in oil. And as long as that oil we're investing in is part of the cheapest 70 million barrels a day of oil, then the oil we're producing is entirely consistent with achieving those Paris climate goals. So I think this thing means Paris means no oil and gas for the next 20 or 30 years is just not good arithmetic. You just do the arithmetic. Yes, we will have to gradually, over that 20, 30 years, evolve from being an oil and gas company to an energy company, but you will still be investing very heavily in oil and gas over that period of time.
No, I agree with that part. You have to. So I tortured a young guy on my team to come up with some stats to sort of boil down to on a more personal basis, what are we really doing with all the renewable energy investments? I think in 2018, we installed 280 million solar panels, which sounds like that's a tremendous amount, 750,000 panels a day. To put that in perspective, each panel will power about 5 or 6 60-watt light bulbs. And the average person needs 16 of those panels to power their home or their life. So And that sounds like, okay, we're making great progress. That's 280 million panels. Like, it's a lot of build. But the context is we added last year almost 80 million people to the planet. On the same metrics of solar needs per person, we were short by 4 times. So not only are we're pushing really hard on renewable energy, and we're even at this fantastic pace of growth and additions, we're still 4 times short on what we're able to deliver. And that's just population growth, not including the growth of the middle class, which is also happening. So I think these things are all compounded. So maybe we're saying the same thing.
No, I think we're furiously agreeing. So well, I'm not sure about where you are on climate, but I'm furiously agreeing that in this world where we have a rapid transition, we will need many energies for many years. And I guess that's one of the things I worry when you sometimes hear these debates, that people say, well, do you believe in renewables or do you not believe? If we're going to have to go to a low-carbon energy system, we will need many fuels and many technologies. Yes, we will need massive growth in wind and solar. We will need to also create carbon capture and storage to use alongside natural gas in the power sector. We will need to develop nuclear energy in many other parts of the world. To achieve this, it is not just like a one-horse race where I'm going to put my money on. You will need many technologies, many energies for many years if we're going to achieve this. And so in that sense, I'd much rather get on that path now with having some sort of security than pretending we don't have to do anything for 15 years and then run a company on the basis that, oh my goodness, let's pretend we don't have to do anything for 15 years and then do it in a violent way. That's the point, which I think is sort of a matter of just logic. As soon as you accept climate science is real, then the rest is just a matter of just logic which just follows.
I think it's really telling that you see a company like Saudi Aramco already so far ahead on that path as well, because obviously just a year or two ago when you were announcing this tie-up with British Petroleum, with BP, Aramco, and other oil majors like Eni in London, they were talking about the climate accords, they were talking about climate change and making serious commitments to moving that dial forward. But I would ask Dan to sort of lay it out for us in terms of the energy mix of the future. There have been so many conflicting reports about what that's going to look like. Bring it to us from that historical
Well, I think
perspective.
one reason is because people don't know, but it's interesting. It's interesting that China has this goal of 2025, these series of industries it wants to be the leader. It's already there in terms of solar. About 70% of all the solar panels are made in China, and another 20% are from Chinese companies manufacturing elsewhere. So it's interesting, and this whole supply chain, you get into electric cars, if you get the large number of electric cars, the issues of the supply chain and where's this stuff going to come from is sort of, it's one thing if it's a few 100,000, it's another if it's a lot more. But I think the mix will change, that, a reasonable expectation in 2050, at least what we have, is that about 27% of energy will come from oil, slightly more from natural gas, which we haven't talked about. Renewables, wind, solar, clearly advancing. I think that we sometimes kind of lose sight. We talk about renewables, but it's also really it's about emissions. And I think something that people kind of skip over. It used to be, it was in vogue, then it fell out, and now it's really looking at again, is what's called carbon capture and use. And very interesting that a sort of focus now on a new focus on nature-based solutions, and saying, really have we actually understand the role of plants in terms of absorbing carbon, if, given the scale of everything. So I think it's kind of focused on dealing with the emissions.
And it also gives light to some serious opportunities for investment when we talk about the democratization of energy, doesn't it, Greg?
I would say the adoption rates might be higher if people could make a lot of money investing in renewable energy, but they haven't yet. So I think probably the reason why the majors aren't buying in size renewable platforms is that when we look ourselves at investing in renewable projects, which we try, like I'm begging, can't we invest in renewables? And you can if you're willing to earn a single-digit rate of return. So our target returns are north of 20%, and our track record is much higher than that. But if we were to just, for the sake of and benefit of the world, invest in these projects, those returns would fall. So I think most people that are investing in them are either doing it because they're mandated by mostly state governments to do it, or they're sheltering tax gains elsewhere in their portfolios.
So So I think if you're a big oil and gas company and you're evolving to be an energy company, you will want to increase your portfolio in renewable energy. I think all of us would agree, under almost any scenario, the fastest growing source of energy over the next 20 years will be renewable energy. So you want to be in part of that if you can. But you want to do it in a way where you have a comparative advantage, where you can carry on returning money to your shareholders. And so BP, in sort of 10, 15 years ago, beyond petroleum, we had one go at that. We were, at one point, I think, the world's second or third largest producer of solar PV panels. Guess what? We have no comparative advantage in mass production of solar PV panels. China can do it far better than us. We'd have lost an awful lot of money. Just over a year ago, BP partnered with a company called Lightsource, which was then Europe's largest solar developer. It's now Lightsource BP. When we started, it had a footprint in 3 European countries. I think it now has a footprint in 12 or 13 globally. And that story is one where you do get returns, because essentially that solar developing story is you develop a solar farm somewhere, you establish a long-term purchasing power agreement, a PPA. At that point, that's essentially has a sort of aspect of a sovereign bond, or so you just secure it as a securitized flow. You farm down your capital in that project. You sell it to people who are happy to hold for a 5 or 6% yield. Sure. You take that turn and you take it elsewhere. And I think that by doing that, that's a different business model to the one we tried 10 or 15 years ago. We think this is a business model which does work in this world, and this business is growing extraordinarily quickly, alongside our wind business, which you already have, and our biofuels business, which you have in Brazil. So I think, and Shell will tell you a story about them investing. Total will tell the story about investing. So I think the way the oil majors are investing differs, and they have different products, but the idea that gradually, if a part of energy is growing very rapidly, and you're an energy company, you want to find ways in which you can participate in that.
Yeah, there's one other thing that's striking that you're doing, but that the other companies are doing too, is their venture arms. Their venture funds are both within kind of the areas of their current business and also in areas outside their business. This is a big development over the last couple of years that hasn't been very visible, but they're players in the venture world.
Absolutely. I want to bring it back, though, to the politics before we move on into natural gas specifically, because for me, this is the sexiest story that you could be covering, because you have the confluence of power, you have the confluence of energy, geopolitics. It's all the great game, and it's all playing out in many ways from the region that I live and work in. Walking through what President Trump's tweets mean today for volatility in the market.
And who are you addressing that question?
To you.
Okay. I was sure it was to these guys.
No, that was your one.
It meant $3 a barrel 2 years ago.
He has been, his views of energy go back to the 80s. I think that whereas this is a hypothesis where you did think that $30 a barrel was really good, it's now recognized the game has changed because the U.S. is a big producer, and the economic impact of the shale revolution is underestimated in terms of what it's meant to the overall economy. But there's clearly a level. I remember being in Vienna when he was tweeting, and his tweets have a big impact. I mean, we love that statement. He said last week, I called OPEC.
And nobody I talked to in Saudi Arabia had any idea. They hadn't picked up the phone.
How do you call OPEC? Do you dial OPEC? I mean, how do you do it? 1-800-OPEC. But whoever he called, there was a message, and prices retreated. So there is a kind of de facto. That's why I say he's a big player in the oil market now, whether it's sanctions on Iran or kind of putting a cap on prices. And it's very interesting then to watch how the countries react. Saudi Arabia, in a measured way.
There's an element of bemusement when I speak to these ministers. They're rather bemused by the entire thing. I think they were caught off guard, certainly, by the extension of waivers initially.
Yes.
But I thought what was really interesting is sort of the comeback in recent weeks, particularly surrounding what's happening with Iran. And frankly, there was a great deal of fear in the months leading up to this about exactly what would happen next and if they would get a clear message from the White House.
Yeah, and I think the first tweet that was just about a year ago, but it's now become part of the game, and I think it kind of puts a top on it. He clearly is thinking about electoral politics, the impact of oil prices on the economy, And so, he's a player.
He's a player.
The politics of oil prices in the US, I think, are about to come over the next few years even more complicated than ever before. So if you're a large net oil importer, which America has been for the last 20 years, it's clear you like low oil prices for your economy. If you're a very large oil net exporter, Saudi Arabia, it's clear you quite like high oil prices. Suppose you moved to being a small net exporter, like the US is about to do over the next 5 years. Then, in terms of your pure economy, your economy benefits from high oil prices. But those benefits accrue to a few oil companies and the government, and the vast majority of your electoral base lose.
I disagree.
Go on, yes, go on.
I disagree, because I think one of the things we've looked at the supply chains across the United States, been a big impact. 2/3 of fixed business investment since 2009 has been related to the shale revolution. And it's all across the country. And I find it, to flip it around, the state of New York, bans pipelines that would carry clean gas to New England. And now I think if there are people here from New York, I believe in Westchester County, people can't hook up gas. There's not enough gas to hook up your house to it because there isn't enough pipeline capacity. But even the state of New York, which bans shale gas, has, when we did our numbers, at least 50,000 jobs that derive from it. So I think it makes it even more complicated.
We're not sort of disagreeing. I think we're agreeing. So we're getting to the point where, for the US, very quickly, high oil prices will be better than low oil prices.
No, but medium. Let's come on. Let's go medium.
I'm just in a black and white world, but
let's be grey. Let's be grey.
But the vast majority of voters will be losing, and the way in which you redistribute those funds. And so fast forward 5 years. All your points about investment, absolutely. Plus, you're a net oil exporter. Do you tweet that I want high prices or low prices?
Well,
and how does that work in terms of the policy?
Well, I think maybe there's been an evolution. I mean, it just seems at this point that there's a certain price level at which the president tweets. And $75 Brent, $65 WTI, tweet.
How real do you think is the danger of an OPEC move in terms of legislation? Do you think that's something that's really on the horizon there?
I think you have to define OPEC for...
NOPEC.
Yeah, they may not know it.
In terms of, so obviously the situation has become quite contentious because we have this incredibly interesting and new relationship over the last several years between Saudi Arabia and Russia, which OPEC plus arrangement. And when I was speaking to Khalid Al-Fallah, the energy minister from Saudi Arabia, who I speak to quite often, and he told me a couple months ago that he has Alexander Novak on speed dial. The bromance is real. How long it will last is a bigger question, given the fact that Mr. Putin has to answer to a lot of unhappy folks back at home. But at the moment, that relationship seems pretty stable. But in terms of the United States, the idea that there could be legislation, that there could be a movement that's an anti-OPEC movement as a result of all of the rhetoric we've heard, in spite of the fact that most major players in the industry would agree that we need OPEC to stabilize the market. How worried are you that that could happen?
Well, I can take that. I think that the OPEC legislation would basically give the Justice Department the right to sue OPEC, perhaps the countries that are members of OPEC, perhaps their national oil companies, perhaps companies that are operating in OPEC countries for violations under the Sherman Antitrust Act. And that legislation bubbles up. When Barack Obama was a senator, he voted in favor of it. When he was president, he shelved it. Whenever oil prices get up, there's a general question, Hadley, that you're raising, which is quite striking, that sanctions has become the kind of tool of U.S. foreign policy, and in all different directions. And so you hear some people on Capitol Hill saying sanctions fatigue has set in because, this goes in so many directions. If prices spiked, I think it becomes more likely that it would get serious attention, and then no one knows kind of how this White House would react, but it could have the effect of really chilling investment that the administration would like to see come into the United States. It could lead to a vast growth in class action suits, a whole host of different things, a lot of unexpected consequences. So I think it's an uncertainty that hangs out there.
And it's very real.
I think it's really important. Okay, just to put this in context, which year did the share of oil in the global energy system peak? Okay, it peaked in 1973, the year of the oil embargo. The share of oil in the global energy system has never been as strong ever since. And why 73? Because at that point, people realised you had the Arab oil embargo on the OECD economies. You realised how exposed you were to those oil imports, and you diversified your economy, the growth of nuclear energy in France and so on. When I travel around the world today, I was in China recently, the way in which they talk about natural gas has changed over the last year or two, because suddenly energy security becoming an increasing issue. In our energy BP produces something called the Energy Outlook once a year, where we think about some of the key risks and uncertainties. We've done a little thought experiment and suppose we move to a world of less globalization, where there's less trade. And we just had a very small tweak to overall growth, and a very small tweak where we said, let's suppose countries which import energy become more concerned about energy security, and they impose a 10% risk premium on all energy they produce. Now, 10% is completely made up. So if you like this way of thinking about it, but you want to do a different number, you can do a different number. 10%, I think, is a relatively small. So if oil price is today at $70, if I can produce my own barrel of oil or an equivalent at 77, I'll take it because of the energy security it provides. The impact that had on oil and gas imports in China and India is really significant, down 20% or so. Oil and gas exports from the US was down around 2/3 by 2040 relative to a scenario where that didn't happen. The profile for natural gas in that scenario was lower than it was in the Paris scenario. So the risk to natural gas from this particular scenario in terms of less trade, more dramatic for natural gas than the risks associated with a rapid transition. And I think history teaches us, remember 1973, that energy security can have profound implications on the energy system. The amount of, the way these trade disputes are happening now, when I have conversations in China, when I have conversations in India, energy security is part of that conversation in a way it wasn't 2 or 3 years ago. And small and just little thought experiments can tell you don't need much for these things to have a big impact. So I think this is sort of it's a first order issue in terms of the nature of the global energy system over the next 20 years.
And Greg, I want you to weigh in on that from an investor perspective. How worried are you about what's happening in Washington?
Yeah, from our perspective, OPEC's done a pretty good job at keeping the market relatively balanced. So we were trying to find, setting up before this on a question that maybe we can have a discussion around. Our view is that if you looked at the pricing crisis that began in November 2014, that's really started because OPEC declared they were going to defend market share over price. And it took 2 years, but OPEC capitulated in November of 16 by finally cutting production. And that's only after we saw oil go to $26 a barrel. And so I think the debatable part, I guess, is that, hey, don't we now live in a world where shale seems to be growing unimpeded, only stopped by its own pipeline capacity constraints? All of the global growth of the past, 4 or 5 years has gone to shale. And so if OPEC has capitulated to shale, that's a question. And then what's the next source of supply, which are the longer-term projects led mostly by 80% by the majors at this point. It's the backwardation of the forward curve that defends OPEC from the next wave of supply growth. That if you are capitulating to shale, you then better beat back those long-term projects, or as we were pointing out earlier, this has a limited fuse on it. The net present value of a barrel 50 years from now isn't nearly as great as it would be to capture it today. So I think we see a backwardation of the forward curve really is benefiting OPEC to defer these long-term projects. We've seen, $500 billion to $1 trillion of projects deferred or canceled. So that's happening. I guess so that's a question for you guys. Am I wrong to think about what maybe OPEC's psyche? Because I think they have given up against shale.
So I have a slightly different perspective. I think what OPEC did in 2014 made perfect sense. I think what they did in 2016 made perfect sense. And I think they're entirely consistent with each other, and neither involved capitulation. So let me backtrack. You think about something like OPEC. What is it? It's a cartel The power of a cartel stems from the fact that it can shift its supply from one period to another. It can shift supply intertemporally. Okay? So it is very well and good in responding to temporary shocks. If demand falls dramatically, it can reduce supply. If supply comes off, it can bring it back. Temporary shocks is very good at. Permanent shocks, it can't respond to, because I shift supply from one period to another, but the shock's there forever. I can't do very much. Now, you have to take that framework and you put it in the context of 2014. What happened in 2014? You had an emergence of a new source of supply in terms of US tight oil. That's permanent. That wasn't going away. That wasn't the margin.
But by the way, every time in history that you have a major new source of oil come into the market, guess what happens? The price collapses.
The price collapses, and Dan, I read your book. I mean, they learned the lesson.
I reread it sometimes.
They learned the lesson. They can't fight permanent shocks. Okay, so what did they have to do? They had to sit it out. They had to sit it out and wait, because if they just took that, I mean, what's the economics of this? High cost oil had to fall off the supply curve. Okay, they weren't Saudi Arabia and OPEC aren't the high cost oil. So if they could take theirs off, that just means high cost oil can stay on for longer. But ultimately, the economics of this is high cost oil has to fall off the supply curve. So it seems to me entirely rational in 2014 what they did. It's not easy, but it's rational. They couldn't do anything else. Fast forward to 2016. So what happened in 2016? Well, the market had come back into balance, but there was a huge level of inventories. And so you needed to bring inventories down to more normal levels. That's a temporary shock. Okay, that's perfect. That's exactly what OPEC is great at. I can take off 1.5 million barrels of oil for a period of time, bring down inventories to a more normal level, and then I can bring them back up, which is sort of exactly what they did.
But I remember in 2016, at the beginning, we had the then Saudi oil minister, Naimi, at our conference in Houston, and he said, we just decided to let the market work, i.e. they withdrew. Okay, market, you get volatility, you get the kind of investment not going freeze on investment and everything. But I wonder, as your Bank of England hat, can you call an organization that only represents about 30% of the market a cartel if 70% of the market isn't there? And another way to think about at least the organization of the market today, what really counts, the new structure of the market, is the big three: Saudi Arabia, Russia, and the United States. So it's a kind of different game. I don't know, is cartel the right word still?
Well, I don't know. So just going back to the other one, the point about this temporary permanent shock, the way I really learnt it, was when you was interviewing Hadley Gamble on the CERA stage in 2016, he said exactly this. He said, history has taught us that we can't respond to permanent structural shocks, but we can respond to temporary aberrations. That was the speech he gave when you then sat down with him. And that's the framework I think they did.
I remember when Ali Al-Naimi was literally called out of the room, and we were all told, His Excellency is taking a nap. And what he was really doing was on the phone with Mohammed bin Salman and getting the lowdown on exactly how he would behave.
And so in terms of the power of OPEC to continue to stabilize the market, as you were saying earlier, all I need to do is be able to shift supply equivalent to the volatility I see in other sources of supply shocks or other sources of demand shocks. What we have seen in the past is 1 million or 2 barrels. If we took 1 million barrels off the market today, the market would respond very dramatically. That's 1% of the market. Likewise, if we have a massive growth of demand, there's 1 or 2%. So if you can control 30% of the market, your ability to stabilize the market is fine, because all you're trying to do is stabilize. Remember, that's all something like OPEC can do, is stabilize. 30% is enormous.
But we should also talk about the role of, Hadley, what you started to do, the role of investors.
Absolutely.
That, people talk about Saudi Arabia as a swing producer. Is New York the swing producer in terms of, A, the hedge funds, and B, the world you live in, the perspective of the people who actually invest in the industry?
Yeah, so it's a dramatically different world now than it was even 2 years ago. So the irony is the way the market is valuing the public equities in the space is pretty grim. Like, by our math, the public equities market is really underwriting oil to be in the mid-40s. When you look at the net asset value of the companies, you have to apply mid-40s price to get to the current stock levels. We've seen oil prices increase, 50% in recent times, and equities have followed by increasing only mid-20%. So it is really out of favor. And I'm sympathetic to the public investor because many of them have lost money at a time when about every other segment of the economy has boomed.
Dan, you were mentioning the big three, Saudi Arabia, Russia, and obviously the United States. Obviously that has a lot to do with the politics as well. How do you see this playing out over the next decade, particularly given the fact that these petrodollar-based economies have a lot more to answer for than the United States?
So, again, is that...
And this is for you.
Okay. I think that I remember I was in Moscow when King Salman came for a state visit year before last, and it was very impressive to see the scale of it. And these were two countries, Russia and Saudi Arabia, that did not have a relationship before. And I think it appears that what started off to be, as Spencer's describing, a kind of deal about stabilizing the market, has turned into a larger geopolitical relationship. And that it suits Russia's purpose to have a good relationship with one of the United States' two most important allies in the region. For Saudi Arabia, it's diversification of geopolitics, to go back to your interest. So I think that's an important new relationship. So, strong relationship, U.S., Saudi Arabia, but Saudi Arabia, Russia, very bad relationship between the United States and Russia that's probably going to get worse. So I think that's kind of the dynamic of it. But a lot of what's going to really happen in world oil is going to be the changing relationship between the big three. And I think what Spencer signed, those two responding, and to also what Greg has said, those two responding to what's happening over here.
And
they're really different. They're really different economies when you think about it. So caricaturing here, Saudi Arabia, very large oil exporter, hugely dependent on oil revenues. The US sort of more or less net balance. So Russia, massive oil exporter, but its economy increasingly becoming less dependent on oil revenues. So the nature of the way that Russia runs its economy, first of all, they have the fiscal balance. They have a fiscal rule such that all oil revenues more than $40 are put in a sovereign wealth fund. So trying to break the relationship between.
Yeah, people don't know that.
No,
I mean, they don't have the vested interest. The same vested interest in.
It's not.
80 is not good for them. I think actually, if I can just jump in there, that I think that one thing that's very interesting. I think the two people who really agree on what the price should be are Donald Trump and Vladimir Putin.
Yes.
They both sort of like around 60.
My impression is, so two reasons why, or three reasons, I guess, why my sense is Russia has a less appetite for high oil prices. One is they are trying to break this link. Secondly, for the individual oil companies, the nature of the taxation regime in Russia means much of the benefit of high oil prices accrues to government. It doesn't accrue to those private oil companies. And third, which is massively important, the ruble floats. You have a flexible exchange rate, and which will move in line with the oil price in the way that the Saudi peg real means that doesn't happen. And so you have these three major players, but they all have very different structures of their economies, and so it's quite different how that will play out.
And it certainly begs the question in terms of the volatility, how long we're going to continue to see that volatility, at least in the near term. But volatility just doesn't scare you, from what I know.
No, we benefited from it. So I think the way we invest, we're trying to create asymmetric risk return, where at current oil prices or oil prices even in the mid-50s, we're trying to find investments where we can make 2 times our money or more. But importantly, hey, if we're all wrong and oil ends up in the low 40s, we still want our money back. So I think the way we see it, hey, if oil goes to mid-40s, things slow down really quickly, investment dries up, and supplies will decrease, and the price will pretty quickly recover. And economies, as you would know, Middle Eastern economies can't function for all that long with oil in the 40s. So it's really not a believable price in the long term.
In spite of the move, everyone has a vision in the Middle East. Whatever country you're in, everyone's got a vision to diversify, but the ability to get there is a bigger question.
It's really much harder. It's much easier to talk about diversification than to do it.
Absolutely. And I think something that struck me starting to cover the region about 10 years ago was the fact that part of my assignment was to go to this Future Energy Summit in the UAE. And what I was very much struck by was the fact that all of these companies, whether they were coming from Europe or the United States, all of these renewable energy companies, a lot of folks from China, so many of them already, the UAE and Saudi Arabia had invested in heavily, and this was 10 years ago, and I realized they're brilliant. They own the energy of today, and they're going to own the future of energy tomorrow as well. How far are we behind the curve when you're sitting in the United States in terms of that diversification of the energy mix.
Can I, just before we go, can I just emphasize Greg's point a little bit more? So can you think, I 100% agree with you in relating to sort of equities being priced at a $40 oil price. I can imagine a world where oil could be almost any price over the next 5 years, okay? I can tell you a story where it's really low, really high. I find it very hard to tell a story where oil prices average less than $50 over the next 20 years. Really hard. Why average over the next? And the reason why is because ultimately the huge quantities of the world's oil production are coming from economies whose fiscal break-even prices are $60, $70, $80 a barrel. The IMF yesterday came out with a new estimate for Saudi of $85
They consistently 85 for the last couple of years.
The world can't sustainably.
Do you think the Saudis were happy about that, or? By that projection, not by that fact.
Well, I think it's which fact? The
85.
Well, I think
Donald Trump probably disagrees with the
IMF is just a point-in-time estimate, as you well know. It's just a point-in-time estimate of looking at the books, looking at the fiscal deficit, and looking at oil production. What price would I need to balance the fiscal book in this year? And that's just a calculation of $85. The whole point, the way I think about Vision 2030 in Saudi Arabia, is trying to reduce that fiscal break-even price. But that's a really hard thing to do. And even if they're really successful and bring it down to 60 or 55, my argument still holds. I find it really hard. The world can't sustainably produce, even if it's only producing 70 million barrels a day in 2040. We're on that really, really rapid path to Paris. And so you get to 70 million barrels by 2040. The world can't sustainably produce 70 million barrels a day at an oil price, a very low oil price. And so I guess I look at the same equity valuations that you look at, and I say, well, what are people thinking? Because I just can't understand how those valuations square with a world where the major oil producers, the world will need huge quantities of oil for the next 20, 30 years, and the price at which that can sustainably be produced will be a function of those economies which are heavily dependent on oil.
Well, I think that goes back, your question goes back to what Greg was talking about, which is, I mean, if we say kind of, we're sort of now taking the Permian just as this machine that's going to keep going, but there seem to be two big things that are happening there. One, there's some signs of consolidation, as per this morning, but with Anadarko. But the other thing is the changed relationship between the independent companies and investors in terms of the investor relationship and what those investors want. And it goes back to what you said, Greg. They kind of want money back, and maybe I think that would be elucidating.
Which, by the way, is interesting because with so many of the conversations that I have with these energy ministers is the fact that they are talking to the shale producers, that they're meeting with them. Everybody's bringing their lawyers to the table, but they're having real conversations because they're deeply concerned that if they're not in tandem, that we have a problem.
But this, Hadley. But what's also happened is just that it used to be growth at any cost. Now it seems to be growth at what cost? And that's another part of the dynamic that's important.
When we look at it, we see that companies that grow trade at discounts to those that don't, which is strange. Big companies trade at a big premium. But in terms of where we are in value, the world's most famous value investor, Warren Buffett, I read this morning, he may be willing to finance Oxy's, or help finance Oxy's
$10 billion
for Anadarko, which that tells you, like, I'm not just saying, hey, things look cheap, and there are reasons why those have run from the space, because we've generally burned more cash than we've generated. Of course, there are exceptions, and a nimble investor can outrun that, but things are dislocated. As a sector, we have about $100 billion of debt that's coming due in the next 3 years. If the debt markets stay closed, that won't be refinanced. We'll have another wave of restructuring to get through. So it can be a frightening time. To me, the big question that we study to try to know the answer to, in terms of what the geopolitical implications might be and where prices might go, is where will U.S. shale peak? Because right now, I think the average guy would say we're going to peak at 15 million barrels, and then it's a pretty big job even to maintain that rate. And for the
that's a very good, because you get there. It's not that, okay, job's done. We're at 15 million. We can go on vacation. I mean,
Yeah, no, it's exactly. These all have 60% decline rates on average, so it's a hard, fast treadmill to keep up. But hey, if we're all wrong and we're going to peak at 20 million barrels a day, I would expect OPEC to fight like mad and say, well, we can't really let that happen.
So suppose it does peak at 20. What can OPEC do? This is this inevitable thing here. The economics of this is high-cost oil has to get pushed off the supply curve. This is not the high-cost oil. OPEC is not the high-cost oil. So it can't fight. Or it can say, I'll take off some of my market supply so you high-cost oil guys can stay for longer. Why would it want to do that?
but what's the high cost? Well, the thing is, what is the high cost oil? Because, I mean, the mantra of everybody is if we were high cost, we've got to be low cost. Canadian oil sands cost is coming down quite substantially. Nobody can survive being a high cost producer.
No, but it's when you say OPEC will fight like hell, what does that mean? I mean,
I think they'll take prices down below 50 to stop it.
and which they can do for a year or two,
Right.
but they can't do sustainably. Okay, so if you think you can kill tight oil, rational thing to do, you can't kill. I mean, I think of in the UK when I was growing up, we had this toy called a Weeble. And a Weeble was this toy, and the thing with a Weeble wobble where you don't fall down. So it's this little toy. You push it down, it always bounces up. Push it down and bounce up. And that's what tight oil is. So you can't kill it off. You can push it down for a bit.
You can change the pace.
Yes, you can change the pace. But you think about Greg's point is I'll undercut. So you can undercut for a couple of years and you give away cheap oil for a couple of years. But then this thing's going to bounce back again. The ultimate thing here is the economics of this is high-cost oil, however defined, has to be competed out. And I think we're pretty confident is the majority of OPEC and the majority of US tight oil is not the high-cost oil. So these things have to live, these two have to live in harmony, relating to your point about these two getting together. The idea that one fighting the other just seems odd because they're the ones that are going to survive in this market. It's the high-cost oil that needs to get competed out.
In terms of that JMMC meeting that's going to happen in just a few weeks from now, what's your outlook for that? Are we going to continue to see caps on production? What is the outlook there for you guys?
For what?
The JMMC meeting, the meeting of OPEC ministers.
Oh.
We have the meeting in Jeddah, and then we have the meeting later in Vienna.
Well, I think the Saudis, President Putin expressed his earnest hope that the OPEC, non-OPEC agreement will, he passionately expressed his hope that they will maintain the agreement. And I think we've seen the Saudis kind of say, we're going to be prudent in here.
Prudent. We're not going to let anyone go hungry, essentially.
Yeah, but on both sides. We will meet the needs of the market, but by the way, they're not going to do what, Hadley, you know very well that happened before the sanctions on Iran that were only partial. Everybody put a lot of oil in the market, and then the price went down a lot.
Absolutely. Give me a price outlook for what we're going to see from the rest of the year, because we have Iran sanctions, we have Venezuela. What's going to happen next?
Well, based upon that, we're not going to have some of the surprises that Spencer referred to. I mean, we're not going to have a big outage in Libya or a complete collapse in Venezuela and so forth. I mean, we're using around $70 for Brent as the kind of average price for the year. Seems in that orbit.
And Greg?
I think we underwrite to mid-50s in terms of what we would need to generate returns. But I think our expectation would be range bound between 50 and 60.
And by the way, the price I was using was
WTI.
Brent, not WTI. So
yeah, so may add $10 to that or $8 to that. Brent.
We have about 15 minutes. I just wanted to open the floor up to questions as well, which we have several of. And I think we have a microphone that can be passed around. Fantastic. Gentlemen.
Question for Dan. My understanding is that the decline rate of fracking wells is pretty great, but it's still, the price isn't going up, the supply isn't going down. First of all, is that correct? And second of all, if it is correct, when do you see the natural gas market becoming constrained by fracking's decline rate, or are new resources just going to come online to replace the ones as they go down?
Well, I think, Greg, you use 60% as the decline
That would be an average first.
Yeah, that would, they start off strong. I think they don't fall. I mean, initially, I think people who thought it was a bubble thought the decline rate would be much steeper, but it's not as steep, and obviously technology is changing. I think at the flip side of your question about gas, the problem is there's too much gas, and gas is produced with oil, and particularly in the Permian, it's one of the things that's holding it back is the pipelines, not only for oil but to get the gas out. And I think it's becoming increasingly clear that how important LNG exports are to kind of the continual growth of the overall shale system.
We had a question right here as well. Thank you.
The news broke while we were in here that Guaido's forces are now attacking to take Maduro out of office. And I'm just wondering your thoughts on that, how it affects it short term and how it affects it long term if he's successful or not successful.
So what is the specific? Because we're not allowed to use our phones up here. So.
Guaido's forces are attacking Maduro in Venezuela to take him out of office with
it's
an armed
interesting that
attack.
I didn't really realize that he had forces.
Apparently so. That's the news that's going on right now.
Yeah.
The news is that the army may be switching. It is the reported news.
Yeah. So. I think that has been the big question, particularly the senior level of the Army, because they're so embedded in the sort of narco kleptocracy of the Maduro regime. And they, in the old days, people used to be able to leave the country and go somewhere else. Now they'll get prosecuted. So that's been the question. If the Army's changed sides, that's a really big deal. I think that the day after is going to be very challenging for the country, and the projections are billions and billions of dollars of getting organized. We've been part of the discussions about, well, what do you do? How do you get this country together? And there will still be diehard Chavistas there, and of course there's still the role of the Cubans there in terms of security, but that the country's going to need massive amounts of investment. And so the oil industry won't come back quickly beyond a few 100,000 barrels a day. And I think it'll be a big question, a human question. I mean, there are up to 2 to 3 million Venezuelan refugees in Colombia, maybe 1 million in Peru, others in Brazil. And then you have a middle class of about 3 million people who've left the country. Who comes back to kind of get the country operating again? So it's going to be a very big challenge. But if that's unfolding, it would mean that the kind of stalemate that's holding, and and then the question is, how will that in the short term affect oil production with everything else happening?
And there's two issues in there, Dan. It's quick. One is how quickly does the human resource come back? The other issue is just how badly in disrepair is the physical assets. And my sense from some of the discussions I was hearing at CERAWeek was some of those physical assets look like they could be in serious disrepair.
Yeah.
So that's going to add. So the people may come back quickly, but the pace at which oil production come back will also be a function of the physical assets.
Yeah. I had a piece in the Wall Street Journal about Venezuela about 2 months ago, talked about how Maduro has basically waged economic warfare in his own country, and it's done enormous damage to it.
Absolutely, no question about where the United States is going to fall on that as well. Will have a major impact. There's another question right over here, too, actually.
I can start.
Yeah.
So the Permian is one of the world's best basins, and it's in a jurisdiction there's no place like Texas, particularly rural Texas. I've asked myself, is shale technology really transferable around the world, or has God just blessed only the United States with this stuff? The answer is it's around the world, but there's really no place like Texas. So to drill a shale well, you need 18 million pounds of sand, like something like 20 Olympic-sized swimming pools worth of water. and you need to have all the pipelines are there, all of the refining capacity is pretty close by. We've been producing their oil for 100 years. The UK has plenty of gas shale, and now imagine, in Texas you're going to roll 1,000 trucks through someone's ranch, and they'll allow you to do it because the rancher owns the mineral rights beneath the property. So in the UK, where the roads are all cobblestone and you have to deal with little bridges, you need probably three times the number of trucks, and the local village people would not get the benefit of even the royalty if oil or gas were to be produced. So I think my conclusion over time has really evolved to, hey, this is a logistical challenge to make this stuff flow. It works in Texas on an economic basis because we have all of the sand, infrastructure, pipe, people, and most importantly, the economic deal to allow the landowners to benefit from it. We are unique as a country in that vantage point. So has the Permian technology been translated elsewhere? It has, to Oklahoma, to Colorado, to Wyoming, to South Texas, but and there are exceptions. Maybe Argentina might develop an industry around hydraulic fracking. But I would say, I used to say it's something like a rolling 5 years, and it's probably eternity.
Right. The other, he mentions Argentina. There's an election in Argentina in October, and that could be a setback because right now, actually, the international industry, all the major companies, I think, including you, are in there. Another country that is doing shale that's interesting, you wouldn't expect it, is Saudi Arabia. They're doing it for natural gas, to produce more gas, to put into power, to free up oil for export. There's some in China. Eastern Europe has been a disappointment. Country that is thought to actually have perhaps a lot of potential is the Bazhenov shale in Russia, but they have enough conventional oil right now that they're not doing it in any way. The sanctions prohibit Western companies from working on that.
So there are places where you can transfer this a little bit. BP has a very successful operation in Oman, which is essentially a tight gas operation. And the reason why we could get those gas reserves, which other companies had tried to, was because we took our learnings from our shale gas operation and took it across. But can I broaden this out a little bit more? The technological changes which are happening to the upstream aren't just shale. The digitalization is completely transforming the way upstream operations are doing. This is an enormous issue, and I know this also often sounds a bit abstract. It's real. So we have digital twins of all our reservoirs in BP, so we can now think and use that digital twin to think about operations and think about refining the way we go about that before we do it on the actual operation. I was fortunate enough, just to bring this to life, I was on ETAP, which is a platform in the middle of the North Sea. It was a Wednesday evening, 8 o'clock at night. I was in the control room, and the people in the control room in the middle of the North Sea were using a feed from a big data which pulls all our reservoirs together, helping them understand in real time how to do that reservoir operation. Okay, so this isn't just abstract when people talk about digitalization. This is real, and it's happening, and it's completely transforming upstream operations. So tight oil and shale is one thing. I think the digitalization of upstream is enormous and really important, and will have a fundamental impact across all types of operations.
And we had one more question, Patty.
Yeah, thank you. So $85 per barrel is what Saudi Arabia needs this year to break even. As Aramco invests $150 billion in creating a gas market, not just for domestic consumption, but for significant amount of LNG exports over the next decade. That's their target. That also will drive LNG prices as we go forward. How does that impact?
Is that a question for Hadley?
So my view is, a key thing about LNG is it's completely changing the dynamics of global gas markets. So if you go back to the world before you saw this huge wave of LNG, global gas markets were essentially, the vast majority of trade were pipelines, and those pipelines means those markets were segmented. You had a US market or an America's market, a European market, and an Asian market. Asian gas would often be a lot higher than elsewhere, the so-called Asian gas premium, because you couldn't take your pipeline from Russia and just put it across to Asia. And so these markets were segmented. LNG just changes completely that. You now have mobile gas. Gas can flow anywhere around the world because it can be transported anywhere around the world in terms of LNG. And so you're moving to a globally integrated gas market, just like you have a globally integrated oil market. And again, this isn't just theory. You just look at the way prices, the increasing correlation between prices around the world, it's completely changed to just even 5 years ago.
And we can take that back to Hadley's discussion about geopolitics. One area where it's having an impact is in Europe, where you'll hear in Washington a lot of concern about importing Russian gas by pipeline, but that really ignores how flexible the market has become, and that people have choices and alternatives now. It isn't a fixed system. I mean, that's a very case study of how the gas market has changed politics.
It's a really important point, and so just to just develop that one point further, I think dependency is a function not of where you buy your energy, but your ability to switch. So each week I fill up my car with gasoline to commute to work.
Which company do you fill?
I always go to the filling station at the end of my road because it's the closest one there.
Is it a BP station?
I can't tell you that. It's the end of my road. Now there's one two streets along. I could go that one, but this one's at the end of my road. So in terms of my oil, my gasoline, I'm 100% purchase it at that station. Am I dependent on that filling station? No. If it closes, I just go somewhere else. So when you're thinking about dependency, it's not a function of where you get that energy, your ability to switch. So if you're in Europe and you happen to have a neighbor that has big pipelines in that and lots of low-cost gas, you can consume that low-cost gas if you have the confidence if something were to happen, you can go elsewhere. LNG has just made going elsewhere an awful lot easier. You don't have to consume lots of LNG. As long as you know you can get it at some point, that can give you greater confidence that you can go and then consume your gas from your neighbor.
The potential of the United States to fill that gap as well. They're so worried about Nord Stream 2 and the influence of Russia at this point in Europe, the ability for the United States to fill the gap, or Qatar to fill the gap.
Yeah, the U.S. will be one of the big three of LNG too. With Qatar and Australia, within a couple of years. And it's interesting, as your question suggests, is here the Saudi interest in being part of the global LNG market.
It's going to be fascinating. I'm afraid we do have to wrap it up. Thank you, gentlemen, so much for joining us, and thank you all for getting up this early to talk about the sexiest story in TV.